Okay, hi everybody. Many thanks for joining today's discussion, which is part of London Climate Action Week. This session is hosted by Carbon Tracker and D3G and is entitled Too Late to Bridge, Discussing the Role of Gas in a Better Recovery. My name is Philippa Nuttall-Jones and I'm editor of Energy Monitor, and I'll be moderating the discussion. And so without further ado, I'm going to pass over the floor to Lily Chau, who is Gas Power Analyst at Carbon Tracker. Lily.
Hi, hello everyone. Good afternoon, everyone. Yep. So thanks for joining this event. My name is Lily, a gas analyst from the Power and Utilities team in Carbon Tracker. I work with my team on our gas power modeling, exploring the economics of gas-fired power plants compared to the cost of renewables. For each gas plant in the region we cover, we also look at its alignment to Paris Agreement and recommend a phase-out schedule for it. So in the upcoming less than 10 minutes, we will discuss the position of gas in the European power sector recovery. There are three main points that I want to touch on. First, economics. Gas is no longer the cheapest source of electricity. Second, flexibility. Gas is no longer the only hope for security of supply. Third, challenges, why it has been so difficult to phase out fossil gas plants. First, to show that gas is economically uncompetitive with renewables in the EU and the UK, I'm going to present our unit-level modeling results, which explores the cost and profits of operating gas plants, and then compares its cost separately to the cost of building new onshore wind and new solar PV. So these are the cost curves of the three technologies. The black line is the long-run marginal cost of operating gas plants in the EU, while the dark green and yellow lines are respectively the LCOE of solar PV and the LCOE of onshore wind. As shown in the chart, building new onshore wind or building new solar PV is already cheaper than running existing gas plants. And in 10 years' time, the cost of onshore wind and buildings or the cost of building solar PV will only be the half of the cost of gas. And for 2040, the gap will grow further to as high as 70%. And these two charts here show how many of the existing gas fleets in the EU and the UK have negative profits and how many with positive profits, comparing 2019 with 2030. From our results, 10% of the current operating gas capacity was unprofitable last year, which is expected to rise to 73% by 2030. In order for the EU power market to be Paris aligned, incorporating our analysis with the IEA's Beyond 2 degree scenario, we're estimating a need of closing down 35% of the current operating gas plants by 2030, not counting the proposed plants that are coming online in the coming few years. And the figure will grow to 74% by 2040 and almost 90% by 2050. So to further bring the conversation towards the concept of flexibility, I would like to show that gas is no longer the only hope for security of supply. To do so, I would like to give you all a sneak peek of our upcoming new reports collaborating with the Rocky Mountain Institute to be published in Q1 next year. We will explore how economic it is to use a portfolio of clean energy resources to replace new combined cycle gas turbines or CCGTs and new open cycle gas turbines or OCGTs, taking into account their flexible nature. In this upcoming report, we'll be focusing on 3 European countries, but conscious of timing today, I'm just putting one of our results of the UK in as an example. Here we define a clean energy portfolio as the lowest cost selection of dispatchable renewables, including onshore wind, offshore wind, and solar PV, and as well as flexibility technologies, including battery storage, energy efficiency, and demand response. This chart here shows the cost curves of clean energy portfolio and CCGT. The yellow curve represents the levelized cost of energy of clean energy portfolio, while the black lines represent the LCOE and the long-run marginal cost of building new CCGTs. So as we can see, today, a portfolio containing a wind, solar, battery, and demand-side management can already economically beat CCGTs, which are treated intrinsically as base load plants. As for peak load OCGTs, however, we still have quite a long way to make the combination of clean energy to be cost competitive with them, mainly due to the OCGT's low utilization factor and fast ramp-up speed and the intermittency of renewables. So with peak demands difficult to be fulfilled by wind and solar, battery and demand-side management are very crucial to make a good economic case of clean energy portfolio. So from here, this chart, we can infer that not until 2039 will new OCGTs be more expensive than clean energy portfolio in the UK. But with merely a 10% reduction in battery storage cost itself, we can already see the process being sped up by 2 years. And lastly, I'd like to drop a couple of small remarks on the challenges of phasing out fossil gas plants. The governments are reluctant to have a transition without gas, mainly for the reason of security of supply. In some cases in the EU, some proposed CCGTs are also positioned to be a reserve plant. Battery storage has a great prospect of fulfilling peak demands. Although some national targets, auctions, and supporting schemes are in place, we are still hoping to see more effort to reduce the still existing planning barriers. Some examples are to provide regulatory clarity on the definition of battery storage providers, or injecting more incentives on battery co-located with renewables. What's positive is that we have a number of consultations and reforms happening to hopefully tackle these questions. Another challenge is the interdependency between district heating and the power sector in some EU countries, such as Germany and Poland. So gas CHPs cannot be easily closed down and are heavily subsidized, as they also provide heat. Meanwhile, coal-fueled CHPs have to be phased out without viable alternatives for low carbon heating. So some people see coal to gas transition more feasible than coal to clean. So as a recap, the first, baseload gas is already uncompetitive with renewable resources in the EU today. Second, the road to replacing peak load gas with clean energy will be a bit bumpy, but with more effort on flexibility technology, we can significantly speed up the process, especially when seeing more successful examples of the US replacing gas peakers with battery storage in the recent years. So for policymakers, on top of tackling all the policy shortfalls I mentioned in the previous slides, we also hope to see a more concrete plan on phasing out fossil gas. So no baseload gas should be planned anymore, and we hope the government could make their stance clear on gas phase out and send the correct market signal to utilities and developers. As for investors, we recommend driving away from investing on new baseload gas assets and evaluate utilities companies on their retirement schedule on certain existing gas assets before it's too late to avoid stranded asset risk in the middle of energy transition. Thank you.
Thank you, Lily. We've got a couple of questions, perhaps a couple of them just to answer very quickly. Somebody said, what are the percentage of each contributor to the CEP? And what are the percentage contribution to the CEP for baseload? I don't know if you can give very quick answers on those two technical questions, and we'll come back to other questions in the debate later.
Yep. So as for CEP, as for CCGTs, we see from our preliminary result, we see less than half, almost half of the almost half of the portfolio goes to conventional renewables, which is onshore wind and solar PV, with solar PV being more. And the remaining are the demand side management technologies and battery storage. So battery storage took the highest proportion at around 30% on top of my head, and the remaining would be an aggregation of energy efficiency and demand side response. And demand side response has got a higher proportion than energy efficiency. As for OCGTs, we see almost over 80% are the flexibility technologies, meaning DSM and battery storage.
Great, thanks Lily for those clarifications. I'm now going to pass the floor to Lisa Fischer from E3G, and we'll come back in the discussion to answer other questions that people had for Lily. Thanks, Lisa.
Yeah, thank you.
Thank you very much, Philippa. I'm also going to share my screen quickly. I'm very glad to be here. I hope you can all see the slides now. My name is Lisa Fischer. I'm a senior policy advisor at E3G. E3G, very briefly, we're an independent climate change think tank looking to accelerate the transition to a climate safe world. I lead our work on energy systems and a lot on the question of what to do with gas in that. And I want to focus my contribution now on gas in the recovery. And just to start off, I mean, both the topic of gas is very complex, but also the topic of the recovery. So I allowed myself to give us a little bit of a simplifying framework and really looking, I'm sure everyone has seen different iterations of this, this type of graph, but really just to illustrate that what I want to focus on is the part of the recovery that's not the immediate health response, but really when we think about stimulating the economy again and restructuring the economic governance for the future post-crisis. And the metrics I want to be looking at is consumption, employment, are we increasing resilience to future shocks that we know about, and also are we actually investing in sustainable growth and livelihoods. So very quick run through, how does gas compare on those 4 metrics? And this is really then also throwing it in for debate later. There's, of course, a lot of studies out there. I'm quoting one around employment, where every dollar in spending on renewables creates around 7 jobs, whereas it creates around 2 to 3 jobs in fossil fuels. Energy efficiency isn't part of that mix, but just to kind of situate gas there in terms of the effect on consumption, which is really important. If you're in a crisis, you really want to boost demand again in the retail sector and so on and so forth. If you invest in gas, that of course depends on the future evolution of gas price. If gas price is low, that allows people to spend their money on other stuff. But the real benchmark is here. I put you experience from post-last crisis in the US, where there was a large energy efficiency program, and the IEA reports that for every dollar invested, there was actually household cost savings of $2. So that means they can take those $2 and purchase other things in the economy and stimulate the economy, act as a multiplier. Resilience to future shocks. I mean, Lily has already outlined quite a lot about that. Alternatives to gas are getting cheaper. This is, of course, dependent on which sector, whether you're talking power, heat, and so on. It's also dependent on the region, but by and large, there is more competitive pressure on the demand side for gas that we need to think about in terms of future shocks. And sustainable growth, again, there's a lot we could say here. I'm just looking at the European context, where by now gas is responsible for more emissions than coal. And we're actually only just starting to learn about supply chain emissions from gas, from methane leakage. And there's a map I put up from the European Space Agency. About half of the global methane hotspots are in areas of oil and gas production that the EU is importing from. So there are also sustainability risks that we're just starting to understand associated with gas. So why, you might ask, does the EU, and this is really the focus of my contribution, still consider making gas eligible for recovery funding? To catch some of you up, because I know we have participants from across the globe, there are current conversations in the EU around the 750 billion euro recovery package. At the moment, it does not look like it will explicitly exclude gas infrastructure from that. And member states can then access this money by submitting their plans. Now, why, given what I've just presented, might some still consider gas in that mix? I'm just throwing ideas out there that we can discuss later, but unresolved geopolitics, Europe's neighbors, many of Europe's neighbors depend on income from exporting gas to the European Union, and the EU is well aware of that. A potentially hyped hydrogen hope, where many believe that gas infrastructure built today can in the future be used for hydrogen. That is true for some cases, but it's probably not true for all cases. Lack of confidence in alternatives. It's certainly easier for a decision maker to think about building one big piece of infrastructure than about one that's dependent on things we haven't studied that well yet, like consumer behavior, where there's much more interactions out there. And outdated institutional design across the EU. It's prevalent that it is the owners of electricity and gas infrastructure that determine energy infrastructure needs, rather than a set of stakeholders that really represents the range of energy solutions we have out there. So these are just a few ideas on why I think we still have gas in the mix, despite it not necessarily faring very well on some of the objective metrics in terms of recovery. And realizing that I've already taken quite a lot of time, I'm not going to go through this, but we can come back to it in the discussion. But the main closing message I wanted to give is, if that happens, if we continue to invest in gas despite actually the sort of objective indicators on that not being as strong, we start to build in some structural risks into our economies. And that means we need to, if we do that, we need to actively manage them. And I've put up a few here around deployment, finance, and regulation, and what that means for consumers, public service companies, but also stability of economies as a whole, which we can come back to, I think, in the discussion. But it's really about that. If we build in those risks into our economies now, we need also to give ourselves the mechanisms to manage those. And with that, I'll hand over back to Philippa. Thank you very much.
Thanks, Lisa. You've given us plenty of topics for discussion there. Michael Liebreich doesn't seem to have joined us just yet. So I'm going to ask Andrew Prag, a senior advisor from the Environment Directorate at the OECD, to come in at this stage. And perhaps, Andrew, you could comment a little bit on what we've heard and also bring a bit more of an international angle in here. We've heard a lot about, from Lisa especially, about the EU. How are OECD countries managing this, and where's funding going from in the OECD in terms of bringing gas into, or not bringing gas into, Building Back Better? Thank you.
Sure, thank you very much, Philippa. So as Philippa said, I'm a senior advisor in the Environment Directorate of the OECD. We're an intergovernmental organization supporting our countries in policymaking, and in the Environment Directorate we have a particular focus on this efforts of a green recovery at present, and how to ensure that we can get economic growth started at the same time as delivering on environmental objectives. So I will indeed do as you say. So I'm happy to comment a bit and then broaden out to a bit the global perspective. I'll just make kind of that through 4 points, I think. The first one, I think it's worth just pointing out just how fast everything is changing in respect to the role in gas. So if the pandemic had hit 2 or 3 years ago and we were having the same discussion back then, the dynamic of the discussion about gas would probably be quite different, even just 2 or 3 years. We wouldn't have yet had this extraordinary politics of countries and companies lining up to commit to net zero emissions around mid-century. We wouldn't yet be seeing the phenomenon of new solar and wind generation being some of the cheapest forms of new power generation in many parts of the world, we wouldn't yet be seeing this big push towards hydrogen, which has been sort of lurking on the fringes of the energy scene for about 20 years, and now bursting to the center. So we're seeing this the role of gas within all that kind of changing before our eyes. One way you can look at this is taking the example of energy scenarios. So if you look at those from the IEA, I myself used to work at the IEA on these scenarios. So if you look at the Paris aligned scenario of the IEA, the sustainable development scenario it's called, what's interesting is to look at the natural gas demand that's projected in 2040 in that Paris aligned scenario over the last few years. So within the projections they've made in the last 3 years, the amount of gas still in the system in 2040 in the Paris scenario is dropped by 15%. So the scenario hasn't changed. It's still same endpoint, same cumulative emissions, but what's feasible to do with or without gas has changed, and that's very interesting. And so given this incredible rate of change, I think it's not surprising that policymakers find it difficult to understand what the role of gas can be in the recovery in different geographies and in the subsequent energy transition that will come through and after the recovery, hopefully. So there's still quite a lot of nuance around the world about what that role of gas will be, and I'll come to that in a moment. But I think in terms of this question of rate of change, it's also important to think of the gas market itself has been changing independently of the pandemic crisis and independently even of the low carbon transition. The move over the last 2 decades towards liquefied natural gas transport instead of pipelines, makes it a more flexible, more commoditized market, and that is really changing the way countries think about their gas security and their gas infrastructure going forward. This year we've seen a lot of LNG shipments just being cancelled because of the flexibility of the contracts. That wouldn't be happening so much in a pipeline world. And it's also interesting that as far as I know, this year we haven't seen a single new final investment decision on an LNG plant anywhere in the world, whereas 2019 was a big year for new investments. So again, things are changing very fast. It's not surprising that it's hard to keep up and understand and really think through the consequences of all this. That's kind of my first main area. Second point is to think of what are we actually seeing in terms of what countries are putting forward in their recovery plans. One of the great positives for me in what is otherwise obviously this terrible year is how there is this great political momentum around the concept of a green recovery, how so many countries are stating that as a priority. Amongst the OECD, we really see the countries stressing the importance of green recovery. Recently at our ministerial council meeting of the OECD, that was part of the communique, and it's a great thing that is there. However, it's quite clear that when you look at the numbers on the ground, there's still quite a lot of fossil-based energy and less green measures, so we say, being put forward in those recovery packages. We're developing a database at the moment to kind of track this, which isn't quite finished. But if you look at some of the other numbers out there, the Energy Policy Tracker, for example, is a great initiative. They see around a third of the stimulus measures announced, the funding of those measures is for clean energy, and most of the rest is fossil. But the role of natural gas in that is a bit more complex. When we dig into the individual measures that are going on, we see within OECD countries there are several that are looking at supporting, explicitly supporting natural gas development as part of their either national or subnational, in some cases both, stimulus measures. We're seeing in the big emerging economies also very clearly shoring up their oil and gas industries, and within that the natural gas element. And then even on the demand side, we see in big countries like India and Indonesia forcing down prices, essentially increasing subsidies to make sure that the companies are surviving through the crisis. So there is a lot going on directly supporting gas. But it's important also to think about how other measures put forward in recovery packages, which aren't explicitly about gas, but which could have important implications for it. So when we take the kind of flagship green recovery measures, most countries that are putting forward those have 3 big ticket items, if you like. One is massively accelerating building energy efficiency. One is push on renewables, and another is this big push towards hydrogen. All 3 of those have big implications for gas. The building energy efficiency, of course, is reducing the demand for gas domestically, and that relieves some of the social pressure around we definitely need gas because it's essential for for well-being, and it's essential for tackling fuel poverty. So if the energy efficiency is done well, it can address that in a way that reduces the longer-term demand for gas. Renewables, of course, squeezes baseload gas out of the system, although there's still a role for peaking, as I'll come on to. And hydrogen also in a very complex area, but essentially will have a potential implication for gas demand. Another type of recovery measure, which is equally important when considering the future market for gas, is around the fugitive emissions that Lisa mentioned. So, in Canada, we're seeing a $750 million fund explicitly for reducing the fugitive methane emissions from the oil and gas sector. There's really big opportunities there, which has both as a recovery measure, but also as implications for the market, which I'll just touch on again in a moment. But in conclusion, on what we're seeing in the recovery measures, certainly mixed messages on the role of gas in the recovery. Sometimes even within countries, federal government pushing for more gas in subnational level, really pushing in the other direction for more renewables. And it comes down to a big point we like to make at the OECD around alignment of policies is important, both within and different levels of government. The last couple of points I will make then is about where we do see potential demand for gas still around the world, and what it means for the supply of gas and where it's coming from. So in terms of the demand side, we heard a lot about the EU power sector already. I think when you look around the world, there's still cases where, if you like, the more dangerous enemy in terms of climate change is still coal-fired generation. Across Asia, rapidly growing economies, well, economies that were growing rapidly before this year, and I'm sure we'll do again. We see even though wind and solar is being built out at incredible rates, there's still a lot of existing coal-fired generation and under construction coal-fired generation. So there's a role for gas there to be providing a fuel switching alternative, as well as providing the balancing service for that great growth in wind and solar that is happening. So in general, globally, we do see a role of gas more shifting towards the peaking plant and the balancing role, but in particular in these big, rapidly growing economies. And then the second area of demand is really looking beyond power, and in particular to industrial uses of gas, where it's of course needed as a heat source in many cases currently, and also as a feedstock in some cases for chemicals and fertilizer. A lot can be done with electrification and heat pumps, making great steps forward, going up to hotter and hotter industrial elements. But there's still a big demand. If you look at countries where industrial demand is growing so fast, at the same time, there's a great demand for increasing electrification, increased energy access. For example, in a country like India, so even though there's wind and solar being built at an incredible rate, there's this great demand for that to be being used for electrification of the population, so less scope for that feeding into making hydrogen for industry. So the demand for industry is probably still there for the near term at least. I think it's fascinating when you look at India, the biggest source of gas demand is actually not power nor heating, it's actually fertilizer production, which opens a whole nother dimension of this interaction of gas with food security and things, which we don't want to get into here, but I think it's very interesting. So this industrial demand in emerging economies in particular is an important area. And then the last thing I was going to touch on is what I said about the supply side. Two things here. One is that this question of life cycle emissions and the fugitive emissions that I mentioned before in terms of recovery measures, it's clear that, if you like, not all gas is created equal. Lisa mentioned the increasing visibility over where these methane emissions are, and I think we'll move towards a market where there's really this differentiation made about the life cycle emissions of the gas in question. And just last week, we saw Engie cancelling an LNG shipment, reportedly because of the upstream emissions concerns about that. So it's maybe a harbinger of a world where gas suppliers really have to compete on the life cycle emissions of the gas. Again, the IEA have done great work here. They sort of working out, estimating where this methane is and what you might do about it. It's probably, just from natural gas alone, it's probably around the equivalent of the annual emissions of Japan. So really huge opportunities to reduce that. And because of the fact that methane has a very strong effect on climate change in the near term, every molecule that you can prevent getting into the atmosphere now is very important, even if you're seeing a longer term transition out of gas. getting hold of the methane now is very important because of that time effect. So it is an important dimension to think about in a question of, if there is still gas in the system, where it comes from, and what its life cycle emissions are. It matters much more than I think most people realize. And then second point on supply is really about the sort of fiscal sustainability and the political stability in those supplier countries. What we've seen, and it's in many ways the COVID crisis has been in some ways a kind of fast forwarding of the energy transition in the way that fossil fuel prices have dropped so quickly. And that's great in some ways, that it seems to have brought forward elements of the transition. But in terms of those supplier countries, it's putting extreme pressure on public budgets, and the efforts towards diversification, take time, are very complex, and there's important aspects to consider in relation to countries which are both oil and gas suppliers. The switch towards gas might be actually a hedging strategy that helps to smooth that transition in a more politically stable way, which could also be important for the world. I think there's many more issues there which I won't get into now, because I think I've taken enough time. But just so in kind of conclusion on these opening remarks, really is that the role of gas in transition is changing fast, and therefore its role in the recovery is changing fast. It's really now a question of which gas, in terms of where it comes from and what its emissions are in the life cycle, and for what demand source, given that there is this overall shrinking role for gas in the system. Sorry if I took too long, but it's such a fascinating topic. There's a lot to get into. Thank you.
Thank you, Andrew. Not at all. I mean, there's a lot to cover in not a lot of time, so you're quite right to take as much time as possible. Lisa, I wanted to come back to you on some of the points that Andrew's just raised in terms of what kind of gas do we want in the system, and what kind of gas is compatible with a 1.5 or a lower than 2 degree emissions reduction pathway, and to build back better after COVID. And obviously we've had some questions about hydrogen, which you mentioned could be hyped, so perhaps you could build on that point a little bit. And also a question about the role of CCS in gas, and so perhaps you could discuss a little bit more, what kind of gas is compatible with 1.5, 2 degrees and building back better.
Yeah, thanks, Philippa. I wanted to, I was following all the questions that are coming in our QA box, and there's a lot of questions around really the technicalities and technology costs. I wanted to, before I answer those, go one level higher and think what we need to think about is, do we want, given what we know which is that electrification will be fairly dominant, there will be a role for gases, but it will be smaller. Is what we're projecting to replace the system in terms of geopolitical relationships, in terms of finance, a like-for-like system? It probably is not. And the question is, what do we need to do to get there? And so this is no longer just a question about technology costs. It's a question about, which is something I was trying to get at with my last slide, around managing risks. When you framed your question, Philippa, around 1.5 pathways and what gas is aligned or not, it's also about what options do we want to create, what options are we starting to close, what risks comes attached with what option. And so if we put all our eggs into the hydrogen basket, the risk is the costs won't come down as fast as possible. And actually, and here I can come to the technicalities, hydrogen produced from fossil gas still has the methane problem. So we need to tackle that very fast, and with CCS doesn't absorb 100% emissions, is also limited in scale, in sort of competitive or economically available scale. So probably we want to use that for those things where we don't have alternative options, and for the rest we want to go for electrification and renewables, which is something we know how to do. It becomes a question on risk management as well. Negative emission technologies, we want to use them to really balance out what we can't decarbonize per se. So same, just bridging it back to the geopolitics. Do we want to replace our relationship with Russia 1-for-1 with just putting a different gas through the pipelines, or do we actually want to transform the relationship in terms of relying on multiple pillars rather than one traded good? And I think these are the questions, given quoting Andrew here, we're talking about fast forwarding, we have to think about much harder and much faster now. So these are questions of of governance, of relationships, energy diplomatic relationships, and of finance and how we channel our development finance flows. Just, I think last week, European development finance institutions pledged to no longer fund finance gas and power post 2030. So we are getting somewhere, but we have to put those pieces together and into something coherent and really in particular work on those diplomatic relationships. Otherwise, we're risking a bit of a crash that we can't handle. I'll come back to some of the technical questions in writing, but I've seen.
Thanks, Lisa. Michael, thanks for joining us. I'd like to bring you in here on the geopolitical side of it that Lisa just mentioned. We've heard from Lily on the more technical side. We've heard Lisa has discussed sort of the EU and the recovery. Andrew's brought in what the OECD and OECD member countries can do. Geopolitically, more kind of what's at play now in terms of the role of gas in building back better and the transition. Is it really this kind of a lack of will almost, or vested interest, that are stopping this move to renewables going faster? Lily's kind of set the figures there and suggested that the technology is there. Economically, it makes sense in many countries now to build renewables rather than building out gas further. So kind of what's hindering this move? Is it the geopolitics, or is there something else at play here?
Okay, thank you very much. And I do apologize for my lateness. It was entirely a mess at my end, so sorry about that. But I think I would probably highlight three things beyond the geopolitics being one of them, which is, if you like, I don't know if you call them softer issues, but kind of non-technical, non-economic issues, or not directly. They're more in the realms of sort of politics and power plays. The first is, well, the first links back to the question of the economics. It does, which is we still don't have a robust answer for the last sort of, let's call it 10 to 20%. You know, I think the renewables, it's easy to see them grow to 40, 50, 60, 70% in the mix. You could push it with demand response, with interconnections, with all that other stuff. But when it gets to the last 10, 20%, we don't have the answer. And so it is rational to be reluctant to get rid of gas, the gas infrastructure, the pipelines, the generation capacity and everything, until we have clear line of sight on that. Because one answer is just to say, well, you know, run the gas 5, 10, 20%, 15% of the time, 20 would be a lot. And let's just figure out offsets or some other way of dealing with it. That's not the worst possible outcome in the grand scheme of things. I'm not suggesting it's the best either. So there is reluctance from a lot of participants because of that, some of which is rational, some of which is manufactured. The second thing that's holding back a rapid switch to the kind of renewables at core, what I call the base cost renewable model, is that there's just stranded assets issues around, particularly I think what's coming into focus is the gas pipeline network. And you know, wonderful discussions about how we're going to heat homes. Most gas is not used in power stations; it's used for heating. And so there's a big struggle to say, well, you know, we've got these gas pipelines. How do we make sure they're not stranded assets? Well, the answer is you steer the world away from a renewables and hydrogen solution, away from a renewables and heat pump solution towards hydrogen. And you'll get a lot of resistance to rapid movement until that is resolved. In geopolitics, we're on the cusp in the US because we're going from a US administration that clearly saw export of natural gas as a way of building international influence, not just economic power at home, but also international influence, and countering the influence of, in particular, Russia. But also diluting the impact perhaps of OECD countries, although that's more about oil, but you know, you've got the sort of Qatars and the Algerias and so on. So we've had a strong pushback against the idea of a no gas world coming from the US because it's such a strong exporter now in the gas markets, and we're on the cusp of losing that influence. Clearly though, that doesn't mean that all countries are going to sort of turn around and say, okay, we've had a good run, but gas is now out of the mix, because you've got some very real questions. You know, Russia, what are its export earnings in a non-gas world? what does Qatar do in a non-gas world? How does Algeria earn money in a non-gas world? What about Nigeria's balance of payments? And so I think I think there's an issue there that really needs to be made explicit, as I'm trying to do here, and discussed. And we need a solution to how do we expect those countries to be on board with whether it's the COVID recovery or the longer term. What do you want them to do? Because they're not going to be passive. They're going to do something on the international stage and use their influence. And we have to have a plan, whether it's to push back and ignore it, or whether it's to somehow help those countries. We need an explicit plan, or they will be very much sort of kicking and screaming along the way and disrupting things like COP26.
Thanks, Michael. Andrew, perhaps we could come back to you on that one, and sort of what is the role of international bodies like the OECD or development banks or other institutions that sort of have the power to decide, to a certain extent at least, where these countries go in the next years, in the years ahead?
Sure, thank you, Philip. And I wouldn't feel like international organizations have the kind of power to direct the governments by any means, but hopefully
no, but you have a certain power over how they spend their money and where that money goes to, sure. Which yeah.
But actually, I should have said that my remarks here are not on behalf of the OECD or the member countries, kind of disclaimer that comes with that. But that said, we do try to provide a sort of balanced, objective view on what works, what doesn't work in terms of policy making. In this case, the bigger question around energy transition and climate change, and a big effort to show over the last few years before the crisis that it's not about doing this just for the planet, that there are really positive macroeconomic implications of investing in the low carbon future, the energy transition, and broader elements of low carbon society around agriculture and other elements. That it is good for growth as well as being good for the planet. That message is reinforced now in the recovery context. So that kind of showing through a hard analysis and modeling that is the case, and convincing governments that is an important role. Supporting the financial sector to be really take into account the risks posed by high carbon investments and the different elements of climate risk going forward, and really laying out the methods and ways that disclosure can be done is another important role. And then trying to build bridges across these geopolitical differences. I think the point that Michael's making around what will these supplier countries do is a very important element in the kind of political stability question I was referring to in my remarks earlier. I think some of them do see the switching more from oil to gas and dedicated gas production rather than just associated gas that's with oil as a part of their transition, potentially with hopes on CCS as becoming in the future suppliers of zero carbon gas, by for example producing hydrogen from natural gas, storing it at source, and then making shipments of either hydrogen or ammonia to consumer countries around the world. That kind of vision. In which case, there's a role for the consumer countries, the OECD members, to really be bringing forward those technologies. And for example, working on CCS. We had a few questions I saw on CCS, and I think there is a role for that, not only generally in any transition, but in gas in particular. We see the economics of CCS is likely to operate around clusters and really having hubs where several different industrial sites come together. That's in order to get over the economies of scale and to get the kind of complexities of the CCS value chain working. So I would say that while you might see CCS as better used for coal or for industrial applications, capturing process emissions from cement or whatever, within that hub industrial cluster kind of model, I think there's definitely a role for gas and potentially producing hydrogen from gas and CCS, which then there's a role for that then becoming a model and being diffused out into the world through international trade, through real efforts to accelerate technology diffusion, which, coming back to your original question, is another role that organizations such as the OECD try to push, is is helping to accelerate not only innovation, but also the diffusion of technologies internationally. So a bit of a roundabout question to your answer to your question, but if I got at some of the points.
Yeah, no, totally. I mean, I think all this is very interesting, but I still think it's quite confusing. I mean, I see some of the questions coming up in the chat, and they're still saying, you know, well, if we go to 100% renewables, or we sort of diminish the role of gas, then will the lights stay on? Which seemed fairly basic questions, and I think in many ways have already been answered. But I'd be interested to know from your points of view, different points of view, what would a successful recovery look like, where we build back better, and we manage to bring on more renewables, and we ensure security of supply, and then we ensure political stability. Is this a pipe dream, or is it something that we can achieve? And how does it look? What kind of needs to happen now to make sure that this happens? And when we're talking about a better recovery, what is that better recovery? Is it just in terms of reducing emissions, or are we talking about also societal benefits? We've mentioned various countries which have societal or political problems which also need solving. So perhaps you could give us we could go round and have a bit of a discussion about what is this better recovery, and what role does actually gas play in it concretely? Lily, perhaps you'd like to start with a more sort of technical look at what's what.
Yeah, so as I have mentioned, in order to smoothly transition to a decarbonized power system, we should really start focusing on the flexibility technologies, interconnectors, and digitization to really pave the way towards flexibility without any peak load fossil fuel power.
Okay, that's super concrete, to focus on the flexibility technologies. Excellent, that's a very clear answer. Lisa?
Yeah, thanks, Philippa. And I wanted to pick up some of the stuff Andrew mentioned and really project into the international space what we need to see. I mean, my question is, the analysis, the type of analysis Lily presented us, is that happening when we look at, you know, what the IEA is doing, what development banks, how they assess what the optimal investment is? Are we actually looking at the energy solutions across the board? Are we actually scanning for those potential future shocks here? Or is there something we need to still, you know, shed some old habits and start looking at the energy system in an integrated way? And similarly, and this may link more to what OECD is also doing, and other players, the IMF out there, when you look at debt and debt finance and support to developing countries as well, you know, what are the metrics we're using in terms of productivity? Are we looking at short-term productivity, short-term ability to repay the debt? This will always, you know, favor oil and gas. Or are we looking actually at some metrics that are a bit more smoothed out and take into account that long-term reduction in volatility first and foremost?
And I'd also, so just sorry, like to add to that, Lisa, as well, Andrew, before your answer as well, in terms of stranded assets, it's a term that we bandy around now in the EU as something that we all understand, but is this a well-known term by institutions, including the OECD or development banks or other countries which are perhaps not at the same stage as the EU in terms of the transition or these discussions?
So I think could bring together the question of what is a better recovery in this context, and the Lisa's question around what are the metrics, and are we being too short term about debt, but also more generally. I think one of the big questions around what is a better recovery, it's using this you know, this unprecedented use of fiscal spending and public funds to really be able to take a longer term perspective for once, and take into account the climate considerations into the targets and the projects that are being funded, and to, you know, really help with this transition in that way. It's a important element of the better recovery as we see it is really making sure that the social dimension, which hasn't really come up yet in this discussion, but really making sure that the social dimension and overall kind of inclusiveness in the recovery is really put at the center. There's something I think that we learnt in the environment policy and specifically climate policy in the last few years before the crisis, is that making sure that this is really seen as a socially progressive movement and something which improves people's well-being and is not just an environmental objective is paramount, and that's become even clearer now in the crisis. So, you know, really being sure something that we talk about a lot at the OECD, is being sure that all these policies are being seen through a well-being lens, that it's really part of people's improving social conditions, well-being conditions that drives this. That is an important part of better recovery. Also, not dropping the ball on innovation in this long term, making sure that the government's role in innovation, partly direct funding for research and development, but also broader role in terms of the innovation ecosystem, support to early stage commercialization of technologies, making sure that that's not forgotten in the recovery. And on the contrary, that really becomes an important part of it, because most of the analysis shows that we're not going to achieve this transition if we don't, with the technologies we have already off the shelf, commercially mature. So that emphasis on innovation, and as I said before, diffusion of technologies internationally is an important part of the picture, not to forget here.
Thanks, Andrew. Michael, do you agree with what we've just heard, or would you like to bring in a different perspective?
No, definitely. And I think, in particular, this idea of the sort of the well-being agenda. And what I would suggest is there's a bit of a mix in the debate in the broader world, and maybe a little bit here, is that there's just very different time constants here. We're still in the middle of this pandemic, and even if we get a vaccine and all that's marvelous, we've got incredible economic hardship and trauma. And so the next, let's call it 36 months, really that's going to trump almost everything. So the lens for the next 36 months is, what can we do to help people get back on their feet economically that isn't horribly damaging, that doesn't set the agenda back? That's kind of, that's a high enough bar for the next 36 months. And then you've got the period out till, let's say, 2030, because that's the iconic, end of the next decade, where we've then got a chance to do a bunch of stuff which could move the agenda forwards. But in a sense, we don't have to deal with, and nor is it helpful. It's not really part of, if we're talking about, hydrogen, I mean, in reality, we're going to be doing pilots and bits of this and that between now and 2030. Whether we do 4 gigawatts of electrolysis or 18 or 20, compared to the scale of what's really going to have to happen, that's actually just, that's almost like the wind industry in 2010. This is just smaller amounts. And so, some of the issues, I talked earlier about the geopolitics. What do you do with Qatar and Russia? Well, that's actually, frankly, a 2030, 2040 issue. You just have to keep them on side for the moment. And I think that when we look at, if this session is really about the building back better and the agenda for now, we've got to do things that put money into people's pockets right now. So that's, energy efficiency in the first line. Then there's things like all the rooftop distributed batteries. I would love to see countries do things like try and get hundreds of thousands or 100,000 existing homes off the gas grid, because we still don't know how easy or how hard that is. We don't have the supply chain. And so we could do something which builds back better, but that also, but that kind of ticks all 3 boxes. Short term puts money in people's pockets. Longer term is not just not bad for, but actually quite good for the climate agenda, and also is part of improving the asset base and the technology base. So kind of works for the longer term. I think at the moment today, those are the things that we should really be looking for. The stuff about, well, how do you do the last 10% or 20% and so on? I think we've got to reach 2030 knowing what that looks like, having done it maybe in a few leading countries. But I find it very hard to say that that's the number one priority right now. I suppose in the UK context, should we be doing some, hydrogen hubs that fits with leveling up in Teesside or Hampstead? Yes, absolutely. But the bulk of what we need to do to get the social license that Andrew's talking about, really needs to be spread across essentially millions of homes and hundreds of thousands of businesses. And that should be the lens that we really look for. And, the impacts on gas, what you can't do for sure is start applying lots of higher carbon taxes and carbon border adjustments and, happily raising people's costs right at this point in the economic cycle when people are under such a lot of stress from the COVID recession, the COVID crisis. So I think we have to be a little bit sensible about stuff like that.
Okay, but where does that actually leave gas then, Michael? Does that mean that basically we almost ignore gas for the moment? We just don't build any more pipelines, but we don't do anything concretely apart from sort of, as you say, governments agree to take a certain boilers offline? What happens? I think,
okay, so let me see if I can come up with a 3-point plan for gas.
Go for it.
One thing is, yes, don't put it at the center of a building back plan. So definitely the Australian plan for, the gas-led recovery, completely idiotic. That's the wrong thing to do. At best, you're building the next generation of stranded assets. That's if it works. If it doesn't work, it's just a waste of newspaper ink, if such thing still exists. I think I would, so I would definitely make lots of signals about how gas is not a bridge, how gas is going to be on the way out, because it's going to be, if it's needed in the system, it'll be replaced by hydrogen, and it may not be needed in the system at all because of batteries and some other things. So I would definitely be making all those signals. So I'd be increasing its cost of capital, so that I'd be trying to push down the amount of investment by lots of signaling if I was the government. And I would be putting money into distributed programs like getting houses and getting businesses off gas, in order to get money out into the community, to establish pilot programs at scale. And one other thing, by the way, which is industrial heat. I'd be putting a lot more money into research of how industrial heat should go directly to clean electricity and not to hydrogen. So that won't affect gas in the very short term, but I'd be sending very strong signals that we're going to electrify everything, rather than promoting this idea that there's going to be, a sort of painless switch from natural gas to hydrogen in the broader economy and so on, because that is economic foolishness. It's not going to happen. We're going to waste hundreds of millions of pounds and euros and dollars and billions of yen playing at that, I'm afraid. But I personally would be saying, no, that's not the route. So I would start that transition away from gas, and gas's role when it's hydrogen will be then in these hubs. It'll be in chemistry, and it'll be in hubs. It'll be for long-term strategic backup of the electrical system. But let's kind of get those things aligned so that we're not building stranded assets of any sort, whether it's in natural gas or in hydrogen. And finally, the fifth point of my 3-point plan, I would be promoting blue hydrogen, because although it's not perfect, it's got other advantages. It's here, it's now, it's affordable. We have companies who could deliver it, frankly, today, and it doesn't have the same land use or ocean use requirements as renewables. And I can't be accused of being anti-renewables, not after 2 decades of this, right? But blue hydrogen has a role to play, and we should stop being sort of, lumping it with nuclear and GMO food and fracking in the kind of, in the naughty box of technologies that we don't dare to talk about. Absolutely not.
Michael, I'm not sure that you can arrive later to debate, and in the minute when we've just gone over time, actually throw blue hydrogen into the mix. I think that's not how I'm supposed to manage that as a moderator now. I'm not sure what to do. I think we're just going to run 2 minutes over, so I can give Andrew, if you can in a sentence say whether you think Michael's plan is largely what would also work for countries, perhaps more developing countries. And then Lisa, I'd like to come back to you for a final word on blue hydrogen, please. Andrew. Yeah,
no, very quick. I think that does make sense, that this element of what can be done here and now, the political realities of the economic suffering that's going on is the most important, which is why I said earlier that, and yet we have this great momentum around the green recovery, and that wasn't a given, that government would really embrace that in their rhetoric. So now we need to put the money where those statements are. I agree on this question of cost of capital. One thing that hasn't come up yet in the EU context is the what's going on in the sustainable finance world, and the famous taxonomy, which essentially does that by, in terms of power generation, just really only allowing gas with CCS to be considered as a sustainable finance option. So I think that is happening. And on the blue hydrogen is what I was saying earlier around the CCS clusters. I really think there is a blue hydrogen role that can help the whole CCS ecosystem to get going, which is so important for the climate change question, whether you have gas or no gas, we do need CCS, in my view, to get to the anywhere close to the 1.5 targets. So yes, it's the blue hydrogen question.
Okay, and Lisa and Lily as well, if you want to just come in very quickly. I mean, the general rhetoric from NGOs, think tanks, is that blue hydrogen is a no-no. We need to go straight to green hydrogen. Do you agree with Michael or not?
Well, on blue hydrogen, all I say, I'm much more careful or cautious around this, mainly because of the question of timing that Michael emphasized. I'm not actually sure it'll be here faster. And given the progress we made on developing CCS in the last decade, we're not necessarily in a much stronger place right now. We may be in very specific locations, but I think it's very hard to generically say that actually it'll come fast enough before green hydrogen will be more competitive. And then you ask yourself, was it worth developing that CCS infrastructure in those places? So I think in very specific places that makes sense, like the Port of Rotterdam, ideally located, but there's many places where that's not worth the effort potentially, and it won't come fast enough to be actually that transition fuel that many people are talking about. I like Michael's 5-point plan, 5 more and he'll be Prime Minister. I think what was missing was a bit the politics. So what do we do with the fossil fuel exporters? What should the EU do? So there is an agenda of trade, finance, cooperation around that in order to, accompany the domestic measures, which will essentially erode demand. And so I think there is an engagement piece both towards other fossil fuel importers like China, South Korea, Japan, but also the US, notably in terms of structuring the global debate.
Thanks, Lisa. Lily, would you like a final word?
Yeah, I also agree with Lisa that before really stepping into blue hydrogen, we should start exploring actually, are there faster ways, more cost-effective ways that are already en route, and do we want to spend the effort on actually starting this blue hydrogen route?
Okay, I'm sorry, we're going to have to end it there, and it's a very difficult note to end on because that's a super interesting discussion we've just opened, but I'd like to thank all our speakers. I think one of the key things that has come out of this, that the role of gas is clearly complicated, but this well-being agenda, and perhaps we should start talking about well-being and actually bring the social aspects into the clean energy transition, as well as just talking about Build Back Better, which sounds sort of quite technical and probably doesn't appeal to lots of people. So thank you to everybody, and I'm sorry we didn't get to answer all the questions, but I'm sure that Carbon Tracker or E3G will share email addresses, and I think they're going to share the slides afterwards. Thank you very much, everybody. Bye.
Thank you. Bye-bye.
Bye.